Welcome. Today we have a talk from the amazing Steve Tustin from the Arizona Central Credit Union here, our mortgage mastermind, to give us some information about how you can get your mortgage to work for you. So we want to thank you so much and thank Arizona Central Credit Union for helping us out with our well-being by lowering our financial stress. So Steve, welcome.
Thank you, Katie. I appreciate you having us. Well, as you mentioned, my name is Steve Tustin. I'm a senior loan officer here at Arizona Central Credit Union. I've been with the organization for just under 10 years. We are a not-for-profit lender, and we have a very strong passion for meeting our financial needs for our members, putting them into a home that they can comfortably afford, providing refinance packages that would put them into a better financial situation as well. So again, I appreciate the opportunity to speak, and let's move forward and go to the first slide. A lot of you will ask, what is a mortgage? A mortgage is an installment loan with a few extra caveats. It is similar to a car loan, but very different. A house is pledged in event of a default. If the borrower or member, in our case, defaults on the mortgage loan, our collateral, which protects our assets, will be the home itself. It is secured. A mortgage is secured with a promissory note and a deed of trust. In addition to a payment usually includes more than just a principal and interest payment only, like you would have on a personal loan or a car loan. Your taxes, your homeowner's insurance, and property taxes are also going to be included in your monthly payment. This is also known as an escrow account. Escrow accounts, for the most part, are mandatory from a lender's point of view because it puts the control in our hands as far as making the insurance payment and the property tax payment. So there's not going to be any issues if something were to happen to the home and we had to come out and file a claim. We would make sure that the insurance was paid on a timely manner. Same thing for the property taxes. It avoids any potential property tax liens against the property, which, again, protects our interest in the property. Every now and again, you might have mortgage insurance on the loan. Mortgage insurance is an element to your monthly payment that actually protects us, the lender, as well. If you've ever purchased a home and you've put less than 20% down, your loan is going to be subject to the mortgage insurance, which is, again, not to be confused with homeowner's insurance or hazard insurance. The mortgage insurance, PMI, is also what it's referred to, private mortgage insurance. It's going to protect the lender because when you're buying a home and coming in with a smaller down payment than 20%, it's going to give us the peace of mind that if you are to default on the loan, then the insurance company that we've partnered up with will then go ahead and insure us on that. So that's kind of a brief rundown of what a mortgage loan is and the monthly payment breakdown versus a car loan or a different kind of personal loan. There are a wide variety of home loan programs that we offer here at the credit union. The most common loan would be the conforming loan, also known as a conventional loan. Those loans can have a loan amount up to $453,100. Any loan amount that exceeds that point is then considered a jumbo loan. Once you hit that break point, you can no longer put 5% down. On a conforming conventional loan, you can put as little as 5% down. On a jumbo loan, you've got to put a minimum of 20% down. And the reason behind that, it's more exposure for the lender. As I mentioned on the last slide, the mortgage insurance, the PMI element, mortgage insurance companies will not insure a loan that is a jumbo loan. So we do need to have that 20% vested interest from you coming in order to give us the peace of mind that we don't need to worry about any future defaults. So the 453.1 cutoff is the conforming/conventional loan to jumbo loan. Here at the credit union, we've got a very unique product line. It's a portfolio product line. We call it the Square One program. It's designed for individuals that may not meet the Fannie Mae guidelines, which would allow you to get a conventional loan, or even the FHA guidelines, which I'll get into here on the next bullet point. The portfolio loan, we do need to have a 20% down program. Again, back to the PMI aspect, the insurance company will not insure the loan if it does not meet the Fannie Mae guidelines. But if there are other strengths to your file, whether it be your debt-to-income ratio is rather low, your credit profile, other than maybe the blemish on your credit, which would qualify for this program. For instance, a foreclosure. If you had a foreclosure on your record, the conventional guidelines, the Fannie Mae guidelines to get a conforming conventional loan, there's a 7-year waiting period from that time. We can actually do it if you've got a foreclosure a year or two old, as long as you come in with 20% down, and we look at your overall credit profile and see that there's other compensating factors, other positive aspects to that credit profile that we can get around maybe not being so comfortable with you having that recent foreclosure. But this is a very popular program, the Portfolio program. We have a ton of realtors, a ton of members out there that word of mouth, it's really getting out, and it's been a very positive program for us, and it's just another option that we have here at the credit union to get our members into a home that maybe other lenders don't have. Then you've got your FHA and VA loans. These are both government-insured loans. The FHA loan is a very strong credit risk-based pricing program, which basically means if you have less than perfect credit, maybe your credit scores are somewhere in the low to mid 600s rather than in the mid to high 700s is kind of a stronger credit profile, if you will. The FHA might be the program for you because they're a little more lenient than Fannie Mae is on the conventional or conforming loans. There's a minimum payment of 3.5% down on an FHA loan, which is 1.5% less than your conventional conforming loan, which was 5%. So there's a little more flexibility there. There will be mortgage insurance on this loan as well. It actually tends to be a little higher than conventional. That's where the government's kind of decided to make up for the little more leniency that they have on you qualifying for a loan. The mortgage insurance premium tends to be a little higher. Then there's your VA loan. This, hands down, is the best loan program out there if you can find a qualified veteran to take advantage of. Reason behind that, the down payment is 0%. You can get 100% financing on this program. There's no mortgage insurance. So this PMI that I've been talking about on the FHA loan, the conforming conventional loan, it does not exist for VA loans. On top of that, the interest rates are going to be most likely, compared to these other programs, the lowest you'll find. So when you put all three of those aspects together, another way of us continuing to thank our military for their service, we've offered, the government has offered this VA loan program that, hands down, if you find a qualified veteran out there, they're going to want to go with this program over any other program. A couple of other programs that we aren't heavily involved with, but in your area there in Coconino County, it might be something to consider, would be the Rural Housing Loan. It's also called the USDA loan, kind of in the outskirts, in the Doney Parks, maybe Mountaineer, Kachina area is where this would apply to. Maybe not in the Flagstaff metro area, but these are other loan programs that are available out there for home buyers. Subprime loans, those are other different lending programs that are out there for people with less than perfect credit. They kind of fall in the same line as our portfolio loans, but this is just kind of a synopsis of the loan programs that are available, that are out there for you to educate yourself about and kind of compare and just kind of learn a little bit about. Moving on to the next slide. When you're securing a home loan, there's a couple of different ways that you can do it. You can get a fixed interest rate or you can get a variable interest rate. As a loan officer, I'm always going to advise my members to go with a fixed interest rate, especially in today's market. Some of you might be aware that the interest rates are continuously increasing. I think in the last 12 months, prime rate has actually increased about 5 or 6 times, and there was about an 8 or 9 year stretch up to that point that it actually did not increase one time. So as the economy continues to improve, the stock market continues to do well, the interest rates on mortgage-backed securities are going to follow suit. So getting a fixed interest rate at this point in time, probably a very smart thing to do, because as economists and other analysts that analyze the market trend are saying here in the next couple, 3 years, rates are going to continue to be on the rise. It's better for budgeting. So, the number one thing that I like to always reiterate to home buyers or even people that are looking to refinance, more than just concentrating on what your interest rate is going to be, we all are really concerned with what our monthly payment is going to be. When you're balancing your checkbook, and when you've got your utilities, your auto loans, your expenses for your children, things of that nature that you're always trying to budget, it's a lot easier to budget a fixed interest rate than worry about what's going to happen 6 months down the line, 12, 18 months down the line, or if you happen to have a 10 or 20-year loan, then it's really hard to budget that. So there's a benefit to having a fixed interest rate. Again, same thing, best for long-term financing plan, and they are slightly higher than a variable rate. That's because we're banking on that variable rate most likely increasing, especially in the last 3 to 5 years. The interest rates have been at all-time record lows. As we came out of the recession, it's going to continue to increase. But that's kind of a rundown here, the difference between a fixed rate and a variable rate. If you go over to the variable rate side, it's also known as an adjustable rate mortgage, an ARM. You might hear that terminology. Again, they can fluctuate with the market rates. It is tied to the prime rate, which again has increased quite a few times over the last year. This type of plan determines when it increases. So the most common are the 5-1 and 7-1 ARMs, where there's going to be rate adjustments mandatory no matter what happens with prime rate at the 5-year mark, 7-year mark, so forth and so on. Your current mortgage financing. So this is what you need to figure in when you're looking to buy a home or potentially looking to refinance to save some money, cut back on your monthly expenses. You'll find if you're looking online at Zillow, Trulia, some of these these public evaluation tools that you find online, you're going to see payment as low as. And what that really is only counting is your principal and interest component. Again, as I mentioned in the first slide, it's very important to budget what your property taxes and your insurance is going to cost as well when you're looking to buy a home. And your escrow account will take care of this. If you've had your mortgage for a while and you've made payments on time, you can sometimes request your escrow portion of your payment to be removed. By doing this, you become responsible for making these payments 1 time a year. That would be for your homeowner's insurance, and then 2 times a year for your property taxes. The benefit is you earn interest on your savings if you repay that on your own, and it reduces your monthly outgoing expense because it's not racking your mortgage payment any longer. However, it is something that you do want to have to budget for at least once or twice a year. All right, moving on to the next slide. So this mortgage insurance element, again, the PMI that I've talked about a couple of times, it's very important to know where you're at as far as what you owe the lender on your mortgage loan and what you've already paid as far as your down payment is concerned, and how much money each month out of your monthly payment is going towards paying down that principal, because that's going to answer the question of how long do I have to pay this PMI, this private mortgage insurance. The Fannie Mae mortgage guidelines for a conventional loan requires that you make that payment at least for 2 years. There are ways to actually request to remove that. Let's say, and about 5 or 6 years ago, this was actually a pretty common thing because the market was so low that there was anywhere from a 10 to 15, 20% appreciation rate that people can kind of look forward to and say, you know what, if I buy this house right now for $100,000, in about 5 years, it's probably going to be worth about $150,000 or $160,000. So that way you don't have to pay that mortgage insurance for the next 7, 8, 9 years or whenever it's scheduled to fall off, depending on how much you put down. What you do need to do is you have to actually get an appraisal done, which could be anywhere from $300, $400, $500, depending on the area that you live. And then once you have that appraisal report and you provide that to the lender that is currently holding the note, and you say, hey, I've now got 20% of equity. When I bought the house a few years ago, I put 5% down, but in combination of paying my monthly payment and $300 or $400 a month was going towards paying down that principal, plus the market has appreciated. Combination of those two aspects, I'm actually at the 20% equity mark. So what do we think about removing this PMI? And that's then going to go ahead and reduce your monthly payment. And as long, again, the PMI, the private mortgage insurance, is to protect the lender's vested interest in the property. So if we feel at that point that there's 20% of equity, we don't see another crash on the horizon, and we feel comfortable that you've paid your payments timely, then we could potentially remove that, and that's going to save you money moving forward. Leveraging your largest asset. When should you use the equity in your home? First, it's very important to understand how much equity you've built in your home throughout the years. Again, this is going to go back to what I just talked about. How much money is going towards your principal, paying that down? How's the market doing? Are homes in your area comparable to your home selling for 2, 3, 5% higher than what you purchase your home? These are things to take advantage of and know where you stand and kind of come up with a short-term goal of, is now a time where I maybe go ahead and get an appraisal done and show my lender that I've got the equity that I need to remove my PMI. You also want to look at your overall budget. A lot of people over the last 3 to 5 years have looked at doing a cash-out refinance and accessing the equity that they have in their home. This is something that you want to consider because credit cards, for instance, those interest rates are astronomical. They're anywhere from 12, 15 to 20, 25%. So your largest asset is going to be the equity in your home. Economists over the years have decided if there's one bill that a borrower is going to be paying, most likely they're going to try and make their mortgage payment first. Because of that, that's why you're going to get a 4.5%, 5.5%, 6% interest rate on a mortgage. Whereas on a credit card, there's no collateral. So your promise to pay as you're racking up that credit card, well, that's the ability to repay on it, is you saying that I'm going to go ahead and pay it. It's a lot easier for borrowers to let a credit card go and get out of hand and pay anywhere around a 15 to 20% interest rate on. So a lot of people have decided to access the equity in their home, pull out that equity at a much lower interest rate, probably cut that rate in thirds, then go ahead and pay off that credit card. Again, the goal, lower your monthly payment, lower your monthly budget so you can budget for other things, whether it's saving up for a vacation or paying down other debt. Very, very good to understand where you're at as far as your equity position. Again, deciding when to use your equity in your home. You may not want to use it. You may want to have this cloud, so to speak, where if something negative were to happen in your lifetime and something were to change with your job and your income situation, at least you know that you've got tens of thousands of dollars or $100,000 in equity in your home in case you needed to, unfortunately, sell, find somewhere else to live. A lot of people decide, I do not want to touch my equity. I'm very concerned with what's going to happen with the market. You never know what's going to happen. But there's others that say, you know what, I'd rather access this equity and put those countertops and stainless steel appliances in the kitchen that I've always wanted, upgraded cabinets, maybe build a pool. That's pretty common down here in the Phoenix area. There's a lot of different ways that you can use your equity in your home. Debt consolidation is probably the most common, just because, again, people are going to focus on their monthly payments, what they have. It's not very fun and comfortable to live paycheck to paycheck. So if you can pay off other items so you can actually free up a few $100s to save each month to put yourself in a better financial situation for the future, a lot of people will use the equity in their home. Now, again, if you were to move, sell your home, then that equity that you've borrowed obviously is going to come off the bottom line when you sell your home, so that's something to keep in consideration. But definitely a positive way to use the equity that you've earned in your home. Another way to access the equity in your home would be a home equity loan. Home equity loan is a separate mortgage from doing a cash-out refinance on your first. The cash-out refinance would be paying off your current first mortgage, and then depending on where the value comes in, you would access a certain amount of money to reach the 80% point. Again, 80% of what your home is worth, you can borrow up to on a cash-out refinance. For a home equity loan, let's say, for instance, you owe $100,000 on your first mortgage. Your home value comes in at $200,000. When you have $100,000 on your first, $200,000 on your second, that leaves you with $60,000 difference that you could have for a home equity loan, because $160,000 into $200,000 is going to be your 80% mark. So some people are like, you know what? The market has just gotten crazy. The rates have gone up almost 2% since I bought my home. I may not want to refinance my first mortgage where I'm at a 3.5% interest rate and pull out that $60,000 and now have a 5% interest rate, because that's where the market is right now. What I'd rather do is just get a separate loan. I'd get a home equity loan at maybe 6.5%, The reason why it's going to be a little more expensive from an interest rate standpoint on that second mortgage is because with it being a second mortgage, that's now in second lien position. If you were to default on the loan, whoever's in first lien position, who extended the credit to you to buy the home in the first place, is going to get satisfied before the company that's giving you that home equity loan in second lien position. So that's why your home equity loan rates are going to be a little higher than if you were to get a first mortgage. Something to think about. There's different options to access the equity in your home. The cash out refinance first mortgage option. You've got one loan, one payment. It's the perfect way to consolidate debt. I don't know about you, but it's not fun when you're balancing your checkbook every month and you've got 5 or 6 different payments that you have to juggle, some on auto pay, some not on auto pay, trying to remember what day of the month it is. It can get a little frustrating. With a refinance, accessing that equity, having one payment could go a very long way. That's the benefit to doing a first mortgage rather than doing a home equity loan. Again, back to the interest rate. You're going to have a lower interest rate because you're in first lien position. There are tax advantages. As of last year, there was a tax reform that was passed in December. So it's starting this year, in year 2018. When you file your taxes next year, moving forward, you can no longer write off the interest that you're paying on a home equity loan, a second mortgage, if you were to pull that money out for debt consolidation, for instance. Whereas on your first mortgage, cash out refinance, every dollar that you pay in interest is still tax deductible, so there's an advantage there. The mortgage cash out refinance takes about 3 to 4 weeks to process. An appraisal is required, a full walkthrough appraisal. Usually takes 20 to 30 minutes. The appraiser is going to go in the home and take a look at the upgrades that you've done, measure the square footage, and then have some back office work when they get back to the office to find out what homes that are comparable in your area, what they've sold for, and how they compare to yours, in essence. Back to the home equity. There are shorter terms that are an option for you, which in the long run could save you a lot of money in interest, for sure. The downside, 2 payments, then you've got your first mortgage that you still have to continue to pay, and then you've got your second mortgage. Again, as mentioned earlier, your interest rate is going to be a little higher. The completion time's a little quicker, 2 to 3 weeks, mainly because the appraisal sometimes is not needed. Sometimes we can actually use a valuation tool that we have access to here, or we can even do what's called a drive-by appraiser and send the appraisal over there, drive by the home just to make sure it's freestanding. The home equity. There are a couple of different home equity loans. The home equity closed-end loan would be the equivalent to a installment loan, an auto loan, personal loan, where you borrow the money, let's say for a 20-year term. You have fixed payments of $180 a month for the next 20 years. Whereas if you did a home equity line of credit, home equity line of credit is going to go back to that variable versus fixed rate element that we talked about earlier. The home equity line of credit, you're only paying interest. It's almost like a glorified credit card that you have without having the actual physical credit card in your wallet, but it's a line of credit that is extended to you with your home being the collateral versus your promise to pay being the collateral, like we talked about earlier on the credit card. The home equity line of credit is going to have a variable rate. It is going to be tied to market rate, prime rate. It's going to continue to increase over the time frame that you owe the money. The nice thing is it's nice to have that peace of mind that you have that money there in case you need it, and you're not going to be paying interest on it unless you use it. Whereas on the home equity loan, let's say you borrow that $60,000 that we talked about earlier, you're going to have a fixed payment for the next 20 years on that amount. Not the same on the home equity line of credit. When you borrow that money, if you borrow a $60,000 line of credit and you decide not to use any money, it's just kind of there for a rainy day. I might have a child that's going to be going to college here in a few years and just want to prepare myself to financially cover some of those expenses. Whatever the case may be, you have that money available, but you're not paying interest on it unless you need it. The home equity line of credit, there's a 10-year draw period and a 15-year payment period. Basically, you can draw on that, and then it's going to go ahead and re-amortize at the 15-year mark, and then you'll have an installment payment at that point. The home equity line of credit is an interest only, so you're just going to be paying interest only on that, depending on what happens to the market. A lot of people actually opt in for this because they feel that the market is going to continue to improve. The homes are going to continue to appreciate, and then once they get to a certain point, they can then go ahead and consolidate that home equity line of credit and their first mortgage and do a cash-out refinance at that point. 4 things to think about obtaining a mortgage. There are tax advantages. Everyone wants a tax break. Everyone wants to figure out how I can save money and not pay so much in taxes. Owning a home and writing off that interest that you're going to be paying each month is definitely an advantage to obtaining a mortgage and no longer renting and becoming a homeowner. Long-term goals. If you pull out a 30-year mortgage and you pay that off in 30 years, well, by the time you hit retirement, you've now, depending on where the market is, you've now got a pretty nice free and clear asset to have. Whether you want to hand that down to children, hang on to that, access the equity maybe when you get older and have a fixed income, whether it's Social Security or pension, you're no longer working. There's a lot of benefits for the long term when you own a home. Again, if you rent for 30 years, once you hit that 30-year point, you don't have any portion, any ownership interest in a home. Whereas on a mortgage, you'll actually own the home, and if we all cross our fingers, the market's going to continue to appreciate, and we won't be in a bad situation like we were about 10 years ago. Blended interest rates. This is an interesting term. This is going back to when I talked about doing a cash-out refinance versus a home equity loan. You know what, Steve? I don't really want to do a home equity, or I don't want to do a cash-out refinance because my first mortgage I bought 7 years ago when the market was just at the absolute lowest, and I have a 3.5% interest rate on that first mortgage. I'd rather just do a home equity loan. Well, we can look at doing that, but your interest rate on this home equity loan, because again, it's not 7 years ago, market rate has gone up. You're going to be looking at a 7%. Now you owe $100,000 at 3.5%, but you want $60,000 at 7%. So that's where you would huddle up with your financial analyst, your loan officer, and you would decide, you know what, does it make more financial sense when I weigh the 2 opportunities out and say, hey, I'm going to sacrifice that 3.5% on the first mortgage to not have a 7% on $60,000 and kind of blend it together at about a 5%, 5.25%. Again, we're going to go back, we're going to look at the monthly payment, see what makes sense. You're going to have that tax advantage of having that more interest that you're going to be paying at a higher interest rate. That's going to be tax deductible at the end of the year. A lot of things to think about when you're looking on accessing the equity and what options are out there. Here's some terms that are thrown out there that you might hear. Loan to value, that's how much you owe versus how much your home is worth. Down payment, pretty self-explanatory, how much you have to put down or you're willing to put down when you buy a home. Loan term, that's going to be your 30-year, 20-year, 15-year, 10-year interest rate. That's how much you're going to be paying the lender or credit union in interest over the term of the loan. Your annual percentage rate. The APR is always going to be a little higher than your note interest rate. There are certain aspects to it, a few fees that are rolled into that APR. The annual percentage rate is probably most commonly known as that 25% interest rate you have on your credit card. Points. If you've ever heard the terminology of buying down your interest rate, this is something that's pretty common in the mortgage industry. You can actually pay, depending on your loan amount, depending on the day and what day the interest rate is locked in, you can pay a certain amount of money, a certain percentage of your loan amount to buy down your interest rate. And then at that point, we pull out a calculator and we say, hey, if it's going to cost me an extra $2,000 to buy down my interest rate by 0.25%, and it saves me $25 a month, we do the math, we take $2,000, divide it by $25 a month, and we figure out in about 50 to 55 payments, it's going to make that money back. So then you're going to decide, do we plan on living in this house for 5 years? Do we plan on relocating? You know, you kind of just, it's a case-by-case scenario. But that's what the terminology of points means, is paying extra money to buy down your interest rate. Mortgage insurance, I think we covered that very early on. That's the insurance that's going to cover us when we lend you to buy a house. If you put less than 20% down. Escrow account, covered that as well. That's going to be your principal, interest, taxes, and insurance payment portion of your monthly payment. Loan fees, these are pretty roughly standard industry-wide. Here at the credit union, I'd like to point out that with us being a not-for-profit organization, I'm confident saying that if you make 8 or 9 phone calls, you may not find anybody cheaper and have lower interest rates than we offer, and if you do, maybe only 1 or 2 different lenders and organizations out there that can offer that. So something to keep in mind. You want to be savvy when you're comparing rates and fees when you're shopping around, but you'll find at Arizona Central Credit Union it's very hard to beat the overall package that we can offer here. Prepayment penalty. This is actually something that we don't see as much anymore. They were pretty prevalent maybe 20 years back, but this is, let's say you opt into a 30-year loan and you pay it off in 20 years. Some lenders will actually charge you a penalty for paying that off because they said, hey, you wanted to borrow this money for 30 years. You're paying off in 20. The credit union does not have this. Most lenders don't have this anymore, but there are still lenders out there that do. So that's very important if you're looking to secure a home loan to find out, is there a prepayment penalty? Because you never know. You could win the Mega Millions. You could inherit some money. You could get a huge raise, get a big bonus at work, and pay off your mortgage sooner, which everybody strives to do, but you don't want to have to pay a penalty for it. Rate lock-in. We touched on this briefly. This is at the point in the loan refinance process or home buying process where you're ready to lock in your interest rate. This is an exciting time. This is where, hey, I don't have to worry about watching this market anymore. I don't have to hear the radio in the morning on the way to work saying the rates are going up and they're not going to stop. Once your rate's locked in, you're locked in. You don't have to look back, and you can feel comfortable knowing that this is going to be your interest rate for the next 15 years, next 30 years, whatever loan term you decide to use. Amortization. This is a great term. It's something that you definitely want to research a little bit because this is going to be the scheduled payments broke down depending on what term, whether it's a 15-year, 20, 30-year, and it's going to go ahead and break it down on how much of your monthly payment is going to be going towards paying down the principal and how much is actually going to be going in paying towards interest to the lender. The shorter your loan term is, the more money you're going to be paying towards the principal. So for instance, rough estimate on a 15-year, it's pretty safe to say that almost half of your monthly payment is going to be going towards your principal, whereas on a 30-year payment, which is going to be twice as long, maybe only about a third of your payment is actually going to be going towards principal. So if you can afford a shorter term, again, look at that monthly payment figure, see if it's in your budget. If you can afford a shorter term, it's going to save you a ton of money over the life of the loan. In summary, our job here is just to kind of bring out some points so you are informed when you're looking to buy a house, when you're looking to refinance, maybe consolidate debt, maybe do some home improvements. Whatever your goals are to put yourself in a better financial solution, it's our goal to empower you as a shopper and make sure you are educated and making the right decision. Again, understanding your equity. That's your number one largest asset that you have. You want to understand it. You want to know how you can put that to work for you and know that it's there for you as you follow what the market's doing. We want to help you make the best decisions for you and your family, of course. And we want you to ultimately compare programs. A lender should not be advising you to enter into a loan program that's not the best fit for you. So we kind of look at your overall picture, and we will advise you on a loan program or two to consider, and then you as the consumer, as the buyer, as the borrower, will then go ahead and decide which loan program is going to be the best fit for you. That is going to sum up my presentation. I know we don't have too many listeners this go around, and I'm sure there will be questions moving forward. So here is my contact information. Again, my name is Steve, last name Tustin. My phone number is 602-523-8167. You can reach me via email at steve.tustin@azcentralcu.org. Please do not hesitate to let me know if you have any questions. I am your resource, and I look forward to hearing from you soon. Thank you for your time, and back to you, Katie.
Yeah, thank you so much, Steve, for all the great information and for being here. And I can even second that I did my shopping on refinance and found that Arizona Central Credit Union was significantly lower in interest rates than other places. So thank you for bringing that up.
Awesome. I'm glad to hear that.
Yeah, and I actually do have one question for you, and I might have missed it. I heard you say that the interest in a cash-out refinance is tax-deductible, but my question is the taxes on that cash-out that you get from the refinance, if it is invested back in the house for remodeling, do you still get taxed on that, or is there a certain way you have to use it where that can protect you more from taxing than others?
That's a great question. I'm going to answer it in a very generic manner because we're supposed to. We're always supposed to direct you towards an actual tax accountant or certified public accountant to answer any tax-related questions. To generally answer your question, though, Katie, if you do a cash-out refinance, one mortgage, if you pay off your current first mortgage and then pull out the equity, that is still tax deductible. You can still, when your new payment, let's say you owe $100,000, you pull out a $60,000 in equity, and your new first mortgage is now $160,000. Well, the interest that you're paying on that new payment on that first mortgage is still tax deductible. It's the home equity loan that would not be tax deductible, and that would be when you enter into another installment loan on the side. You do not pay off your first mortgage. You get a home equity loan on the side, and that's in second lien position. From my understanding, as of last year, that is no longer tax deductible. If for home improvements, if you were to purchase a brand new house and do what's called a purchase money second, where you basically borrow the 20% down to put down, so you have two mortgages, I'm understanding that is still tax deductible. But for debt consolidation, home improvements, accessing the equity that you've earned over the years in the form of a second mortgage and a separate loan from your first, that is no longer tax deductible. But definitely consult with your tax advisor and get the rundown on that.
Great. Thank you, Steve, for all the clarity on that. And I just want to invite anyone who's watching this for Wellness Points that you can reach out to Steve if you have any further questions, and reach out to the Wellness Program and let us know if you have any other topics you'd love the Arizona Central Credit Union to present on. And with that, we'll close our webinar today, and thank you so much for listening.